Good morning, everybody. Today is Thursday, September 19th, 2013. Welcome to my video update on the markets and the economy. That's what I'm going to be focusing on today. Yesterday was a real big day in the markets. The Federal Reserve came out at 2 o'clock, and almost every economist out there and money manager expected them to finally announced they were going to cut back on their bond buying program. Currently, the Federal Reserve is buying $85 billion a month in treasuries and mortgage-backed securities in order to stabilize and help the markets. Whether or not this works or not is a total different conversation, but yesterday they prepared the markets for a September taper. And they came out yesterday at 2 o'clock and surprised everybody by saying they were not going to taper. And what we saw yesterday was one of the biggest short squeezes I've seen in my career. A short squeeze is when there's a lot of investors out there, and in this environment mostly hedge fund managers and pension managers and day traders had positions on to short the market, the bond market, the stock market, and commodities, because if the Fed was going to cut back on stimulus, we expected interest rates to rise and all of these areas to go down. Well, that didn't happen. The Fed came in and said they were not going to lighten up on any of the tapering, and everybody who was short was forced to go in and buy everything that they borrowed, meaning that they were short and bought on margin, and therefore that was the squeeze, that squeezed the market higher, which is why we call it a short squeeze. You saw gold, which was down almost under $1,300 an ounce, closed at like $1,360. It was up over almost $60 yesterday. It's a huge move for one day, but that was because so many people expected these things to go down. Whether or not this is all good for the market, we're going to have to see. I did include a chart here that you'll see, and it shows the Federal Reserve's balance sheet since 2009 and how as it increases, so does the stock market. So you would think so far this would be pretty good for stocks. We'll give it a couple days to see what happens. I do think it is good for stocks. I don't think it's good for the overall economy. We are no doubt creating a bubble by doing all this. If you look at what we're doing right now, the bigger you blow up a bubble, the bigger the explosion. We saw it with the housing market, we saw it with the tech bubble in 2000. There's no doubt about it that is going to happen, but it might not happen for another couple years. Who knows where we're going to see the S&P 500 before this happens. But at some point we do know it's going to happen. Bond yields can't stay this low forever. The average yield on the 10-year in the last 200 years is 5%. Well, we were at 164, now we're at 260. Imagine if we get anywhere near the middle. What that would do to markets. Well, we're going to have to see what happens there. I don't expect to see that anytime soon, and I think the Federal Reserve knows that as soon as they pull back, they are going to really hurt the equity and bond markets. But at some point, they're going to have to do that. We have to take our medicine, and we'll be prepared for that. I'm not too worried about that moving forward. I thought yesterday was a great opportunity for the Fed to finally come in and do a little bit of that, but it didn't happen. Until I make any moves on not chasing the market, but getting more invested, because we did take some off the table ahead of this announcement. We are going to put that do want to put that money back in. Right now, I just feel like the markets are very volatile, but right now we did get a pretty good free and clear from the markets from the Fed for the U.S. equity markets. Also, things that were really beaten down, stuff that we haven't owned in a while, corporate bonds, government bonds, utility stocks, real estate, things that are very interest rate sensitive, have kind of gotten a green light to go back up for people who are looking for yield. That's been one of the biggest problems the last couple months is, it doesn't make sense to own an asset that's producing a 4% yield if, a slight move in interest rates can mean there's a 10% loss. The bond market is negative on the year. The utility market's negative. The real estate REITs are negative because of the interest rate move we saw this year. And now that we've gotten a free and clear from the Fed, I think it's time for us to put some more money back in here and start earning yield. So you will see some changes moving forward. One other thing I do want to mention is there is the issue with the debt ceiling coming up in the beginning of October. Is the government going to do what's best for the overall economy or for their party? We're going to have to find out. Hopefully it won't get ugly like last time, and it won't put the markets on edge, but we're going to see what happens. These are definitely interesting times. In the meantime, I have appointments with many of you to go over some stuff, and anybody else, if you want to talk or come in, please let me know. I'd be happy to meet with you. And again, like always, thanks so much for being my client, and have a wonderful weekend.